The stock market's shaking, headlines are screaming chaos, and one name keeps popping up: Donald Trump. The title of this video says it all. It's over. Trump deliberately crashing the stock market. But is that really what's happening? Is this the end of the market as we know it? Or is there a bigger game at play here? Stick around, because we're going to unpack this step by step. If you've been watching the news or scrolling through social media lately, you've probably seen the panic. Stocks are sliding. People are asking, should I sell everything and run? Maybe you're feeling that itch yourself. I get it. I've been obsessed with markets for years, and I know how overwhelming this can feel. But here's the thing. I'm not here to fuel the fear. My goal is to cut through the noise, give you the facts, and show you how to think about this like a seasoned investor, not a headline chaser. So, what's really going on? The idea floating around is that Trump might be deliberately tanking the stock market. Sounds wild, right? But there's some logic behind it, and a few key triggers that tie back to his decisions. We're going to break this down into three major factors driving this mess: his trade policies, his global alliances shakeup, and a theory that's got everyone talking: could he be crashing the market on purpose? By the end, you'll have a clear picture of what's happening and how you can navigate it. Before we dive in, if you're new here, I'm all about breaking down complex money stuff so you can make sense of it. No jargon, no fluff. Hit that like button if you're ready to learn something today, and subscribe if you want to keep leveling up your financial game. Alright, let's get into it. First up, Trump's trade moves and why they're rocking the boat. Trigger number 1, the trade war roller coaster. Trump's been pushing tariffs, taxes on imported goods, hard. Think of it like this. If you are buying a $100 TV from overseas, a 25% tariff means you're now paying $125. That's the basic idea. He's used tariffs before, like 25% on steel imports back in 2018. And he's hinted at more to protect American jobs. Countries like Canada and China often hit back with their own tariffs. And suddenly, it's a global tug of war. Now, this isn't new. Tariffs have been a Trump signature move. He's the guy who loves a good negotiation. But here's where it gets messy. These back and forth tariffs aren't just a US issue. China's been rallying trade partners like India and Brazil to sidestep the US entirely. The result? Higher prices for everyday stuff: cars, groceries, you name it. And a stock market that's freaking out because no one knows what's coming next. So why does this matter to you? Well, when companies pay more for materials, they don't eat the cost. They pass it on. That $5 loaf of bread could be $6 soon. That $30,000 car, maybe $32,000. And if this trade war escalates, it's not just a US problem. Supply chains are global. Whether you're in New York or New Delhi, you'll feel the pinch. Let's dig deeper into how this could play out. Let's rewind for a second. History's got some lessons here. Back in 1930, the US passed something called the Smoot-Hawley Tariff Act. The goal was simple: tax imports, boost American businesses. Sounds familiar, right? But it backfired. Big time. Other countries retaliated. Trade dried up. And what started as a recession turned into the Great Depression. Businesses shut down, unemployment spiked, and the stock market crashed hard. Fast forward to today. Trump's tariffs aren't as extreme yet, but the vibe's similar. He's already shown he's not afraid to slap tariffs on key imports, like steel and aluminum from Canada and beyond. When that happens, trading partners don't just sit still. They fire back. That drives up costs for everyone. Steel prices rise, construction gets pricier, and the Dow gets jittery. It's a pattern we've seen before. Here's the kicker. Tariffs aren't just about punishing other countries. they ripple. Imagine you run a small business making furniture. Your wood's imported. Now it's 25% pricier. You either raise prices, losing customers, or cut profits, risking layoffs. Multiply that across thousands of businesses, and you've got a recipe for economic slowdown. Investors see this. They panic, and the market dips. But is Trump really trying to tank everything? I don't think so. Look at it like this: he's a deal guy. Tariffs might be his poker chips. Push hard, scare everyone, then negotiate a better trade deal. If he pulls that off, US exports could boom long term. The catch? The uncertainty is killing the market right now. Every tweet, every new tariff threat sends stocks on a wild ride. And uncertainty? That's investor kryptonite. Let's zoom out globally. China's not sitting still. They are rallying the BRICS countries Brazil, Russia, India, South Africa to trade without the US. Imagine a world where the dollar is not the go to currency anymore. That's a long shot. But even a step in that direction shakes confidence. Higher prices, weaker trade ties, a jittery market. It's a perfect storm. So that's trigger 1. Next up, Trump's shaking up alliances. Trigger 2, global stability on the line. Trump's been vocal about NATO. You know, that military alliance keeping the West tight. He said, why should the US foot the bill if allies aren't paying their share? Fair question, maybe. But here's the domino effect. If the US pulls back, it's not just about defense budgets, it's about trust. Markets love stability, wars, power vacuums. Anything that smells like chaos sends them tumbling. Picture this: Russia sees a weaker NATO and pushes into Eastern Europe. Energy prices spike. Think $150 a barrel oil. Supply chains for everything from tech to food get messy. Stocks tied to energy, manufacturing, even consumer goods take a hit. Or China flexes in Asia, and trade routes get dicey. It's not happening yet, but the threat of it, that's enough to spook investors worldwide. So, trade wars and shaky alliances, two big triggers. But there's a third one, and it's the wildest theory yet. Is Trump crashing the market on purpose? Stay tuned, we're diving into that next. We've covered Trump's trade war chaos and his alliance shakeups. Now, let's get into trigger 3. And this one's a doozy. There's a theory out there that Trump might be crashing the stock market on purpose. I know, it sounds like something out of a movie, but stick with me. There's some logic here, and it ties into something massive: the US national debt. Here's the deal: the US government owes a staggering $36.5 trillion. That's trillion with a T, a number so big it's hard to wrap your head around. Now, when you've got debt like that, you're paying interest on it every year. Think of it like a giant mortgage. If you owe $50,000 on your house at 3% interest, you're shelling out $1,500 a year. Bump that rate to 6%, and it's $3,000. Scale that up to 36.5 trillion, and tiny rate changes mean billions in extra cost. So where does Trump fit in? Well, he is no fan of high interest rates. He's said it himself. High rates choke growth, make borrowing expensive, and slow everything down. Right now, rates are higher than he'd like. And the Federal Reserve, the folks who set them, won't just slash them because Trump says so. They're independent. But here's the twist: the Fed does cut rates when the economy is in trouble, like, say, during a stock market crash or a recession. Now, follow me on this. Every year, the US has to refinance chunks of its debt, billions worth. If rates stay high, say 5%, governments stuck paying way more in interest. But if rates drop to 2%, that bill shrinks big time. For example, on just $1 trillion, a drop from 5% to 2% saves $30 billion a year. Multiply that across the whole debt, and it's a game changer. money that could go to tax cuts or roads instead of interest. So, the theory goes like this. What if Trump's pushing the market to the brink? Tariffs, uncertainty, all of it, to force a crash? If stocks tank and recession fears kick in, the Fed might slash rates to save the day. Trump gets his low rates, the debt gets cheaper, and he can spin it as a win for America. Crazy, right? But look at his own words. He said, let's get interest rates down. Nobody gets rich when they're high. Maybe this is his playbook. Now, is there proof? Not exactly. It's a theory, but it's not baseless. Markets get shaky when Trump talks tariffs. Back in 2018, the S&P 500 dipped every time he escalated trade threats. He's not shy about shaking things up. If this is his move, it's a high-stakes gamble. A crash could reset the board, but it'd mean short-term pain, lost jobs, shrinking portfolios, before any payoff. The question is, how long can the market take this roller coaster? Here's where it gets real for you. Whether this is deliberate or not, the market's reacting. Uncertainty is spiking, stocks are dipping, and people are scared. But here's the good news. Crashes aren't the end. They are part of the cycle. Since 1929, every major US market drop, 1930, 2008, you name it, has bounced back. The trick is knowing how to ride it out. So, let's shift gears. What can you do about this? Before we get into strategies, think about this. Markets don't care about theories. They care about confidence. Right now, confidence is shaky. Tariffs are driving up costs. Alliances are wobbling, and this debt play could be the wild card. But history shows us that chaos creates opportunities. Whether you're in the US, watching the Dow, or halfway across the world, tracking your own markets, the principles are the same. Let's talk about how to turn this mess into a win. Step 1. Get your foundation right. I'm not here to tell you what to buy. That's up to you. But I can tell you this. Before you even think about jumping into a shaky market, you need a safety net. Imagine you've got $5,000 to invest, but no emergency cash. The market dips. You lose your job. Now what? That's why step 1 is building a buffer, 3 to 6 months of living expenses. For example, if your rent, food, and bills run $2,000 a month, aim for $6,000 to $12,000 tucked away. It's not sexy, but it's your lifeline. Got that covered? Great. Next, tackle high interest debt. If you're paying 10% on a $10,000 credit card, that's $1,000 a year down the drain. Compare that to stock market returns, historically around 7 to 8% after inflation. You're losing ground just sitting still. Clear that deck, and you're ready to play offense. Let's keep going. Step 2. See the dip as a sale. Picture this. Your favorite store has a 20% off sale. You don't panic. You buy. Stocks work the same way. During the 2008 crash, the S&P 500 dropped nearly 50%. Scary, right? But if you'd invested $1,000 at the bottom, it'd be worth over $5,000 today. Even better, if you'd kept adding $100 a month through the recovery, you'd be sitting on tens of thousands. That's the power of buying low. Now, no one knows the exact bottom. Don't try to time it perfectly. Instead, use something called dollar cost averaging. Say you've got $1,200 to invest. Don't dump it all in today. Spread it out. $100 a month for a year. If stocks drop more, you buy cheaper shares. If they rise, you're still in the game. It's simple, it's steady, and it works anywhere. Wall Street, London, Tokyo, you name it. But here's the catch. You've got to stay calm. Market drops spark fear. 10% corrections happen every couple of years. 20% bear markets every 7 or so. The big 40% plus collapses? Rare, but they recover too. In 2020, the market crashed 30% in weeks. then hit new highs by year end. Panic sellers lost out. Steady hands won. So, don't sell when the headlines scream it's over. That's when the real game starts. Step 3. Spread your bets. Imagine you put all your money, say $10,000, into one stock. It tanks 50% and you're down to $5,000. Ouch. Now, split that $10,000 across stocks, bonds, maybe some gold or real estate. If stocks drop, bonds might hold steady. Gold might even climb. Look at 2008. While stocks crashed, gold jumped 5%. Diversifying doesn't mean you avoid losses, it means you're not wiped out. Here's a global twist. Think beyond your backyard. US markets might be shaky, but what about Europe or Asia? If tariffs hit American goods, companies elsewhere might gain. A $500 investment in a broad index, like one tracking 500 top companies, gives you exposure without picking winners. Add in some dividend stocks, say one's paying 3% a year, and you've got cash flow even when prices dip. Let's tie this back to Trump. If his trade war drags on, consumer stocks might hurt. Think car makers or retailers facing higher costs. But energy or defense, they could thrive if tensions rise. The point is, don't put all your eggs in one basket. Mix it up, and you're less tied to any single outcome, whether Trump's crashing the market or not. Step 4. Think long term. Markets are a marathon, not a sprint. Let's say you're 30, with $5,000 to invest. At 7% annual growth, pretty standard historically, that's $38,000 by age 60. A crash today? Just noise. Even if it drops 20% this year, history says it'll climb back. The Dow fell from 381 to 41 in the 1930s, then hit 1000 by the 60s. Time smooths out the bumps. So, what's the takeaway? Trump's moves, tariffs, alliances, maybe even this debt play, are shaking things up. The market's jittery, and yeah, it could get worse before it gets better. But this isn't game over, it's a chance. Get your foundation solid, buy smart, diversify, and stay patient. That's how you turn chaos into cash flow. Let's wrap this up with some final thoughts. We've unpacked Trump's trade wars, his alliance shakeups, and that wild theory about him crashing the market on purpose. Plus, we've covered 4 big steps. Build your foundation, buy the dip, diversify, and think long term. Let's add a couple more ideas to seal the deal and make sure you're ready for whatever comes next. Step 5. Keep learning the cycles. Markets aren't random, they move in patterns. Take corrections. Those 10% drops, they hit every year or two, like clockwork. Bear markets, 20% or more, roll around every 7 to 10 years. The S&P 500's seen over 20 of them since 1928. And every single one recovered. Even the Great Depression, a 90% wipeout, bounced back by the 1950s. Why does this matter? Because knowing the rhythm stops you from panicking. Here's an example. In 2022, the market dropped 25%. Inflation, rate hikes, you remember it. People freaked out, sold everything. By mid-2023, it was climbing again. If you'd bought $1,000 worth of an index fund at the bottom, you'd be up 30% today. $1,300. The lesson? Crashes aren't the end, they're pit stops. Whether Trump's moves trigger a 10% dip or a 40% plunge, history says it's temporary. Study the past, and you'll see the playbook. Step 6. Control what you can. You can't stop Trump's next tariff tweet or predict the Fed's rate cuts, but you can control your habits. Say you got $200 extra a month, maybe from skipping takeout or picking up a side gig. Invest it consistently. At 7% growth, that's $125,000 in 30 years. A crash might knock it down to $100,000 for a bit, but it'll climb back. Point is, focus on your moves, not the headlines. Let's bring this full circle. Trump's trade policies, they're jacking up costs and spooking investors. His NATO stance, it's rattling global stability. The debt theory, if he's pushing for a crash to slash rates, it's a bold move, maybe genius, maybe reckless. As of March 18, 2025, the market's feeling the heat from all this uncertainty, and volatility is up. But here's the truth, markets don't die, they adapt. Think about this globally. In the US, a $10,000 portfolio might be hurting. Same goes for a 10,000 pound one in the UK, or a 50,000 rupee one in India. Tariffs hit everywhere. Higher prices don't care about borders, but recoveries don't either. When the dust settles, the smart ones, those who stayed calm, spread their bets, and kept going, come out ahead. That could be you. So, is Trump deliberately crashing the market? Maybe he's playing 4D chess with the debt, or maybe he's just swinging hard and seeing what sticks. Either way, it's not over, it's a shift. Your job isn't to predict his next move, it's to position yourself to win, no matter what. A crash today could be your ticket to millions tomorrow. Look at the billionaires who bought big in 2008. Buffett, Icahn, they didn't run, they pounced. Final thought. Fear sells headlines, but patience builds wealth. The views and opinions expressed are based on my personal understanding and are not intended as financial advice. Please conduct your own research and consult with a qualified financial advisor before making any financial decisions. Since you have stuck around till the end of this video, it's clear that you found this topic intriguing. And I think you'll definitely want to check out the videos popping up on your screen now. They explore even more fascinating topics in finance that might just challenge your perspective. And if you enjoyed this video, make sure to like and subscribe for more videos that break down complex and foundational topics in finance. Thanks for watching.